Hey dividend investors, if you're looking for an ETF that has a monthly distribution that pays a ridiculously high dividend, this is definitely the video for you, especially if you want to diversify your investments if you're obviously living in Canada. So let's get down and let's check out ZWP, which is a BMO European High Dividend Covered Call ETF. If you don't know what a covered call ETF is, that's okay. If I remember, I'll link it above in a card. If I forget, then of course go check out my channel. I have broken down what a covered call ETF is. Okay, so the ZWP BMO European High Dividend Covered Call ETF is really good. I really like this ETF. So first off, as of right now, it is paying an annualized distribution yield of 7.3%. Of course, this will change depending on how high or how low this ETF goes. So of course, if Europe starts going into a recession because of COVID, or at least a deeper recession, then of course this dividend will go higher, but the stock price of this ETF will go lower, and vice versa. If the stock price of this ETF goes higher, then that dividend goes lower. And of course, we always want it to go higher when it comes to the stock price. It means it's healthy and happy, and it's just a negative or somewhat negative side effect of a lower distribution yield, but if you invest now, that's what essentially you would be getting. It is monthly, which is huge. When it's a monthly distribution, that means that you will get paid every single month. So if you're retired or looking to retire or just looking to work less, then this is a fantastic ETF because it's going to give you an income that is going to be the same, pretty well close to the same every single month. Now, something that I do look at with ETFs is the market volume. So the volume is roughly 20,000 shares a day being traded, which is, in my personal opinion, enough to be able to get out of it in time. And what I mean by that is if the stock market just decides, well, the world's going to go on fire and, of course, the whole world is going to go into a bad recession, you want that to be high enough so that you can actually sell it and get out in time. So when we look at the distributions, I want it to be, when it comes to a monthly distribution, I don't want to see it go down in down in value. I don't want to see lesser money given to me. I want to see the same, if not better. Because if it's the same, at least you'll know that you're still getting 7% a couple of years from now, or at least that's what you're hoping for. And of course, the stock price of the ETF will continue to hopefully go up. So right now, it is pretty well set at 10 cents per share every single month. When we look at 2019, it was between 10.5 and 11 cents per month, which when the market is doing superiorly well with covered call ETFs, you're generally going to see a bit higher dividend with covered call ETFs because of course they're playing the yield on covered call options and things. So keep that in mind. The market has done really well up until of course it died in March. So let's just keep that in mind. And then when we look in 2008, it was around that 11 cent mark. And of course, that was the first month, that was the second month. And sometimes when you're looking at covered call ETFs, the first couple of months are going to be extremely high versus what they end up being in the future. With it being currently at 10 cents per share, I still think that this is safe in the long term, but that's my own personal opinion. Now, if we look at the year-to-date numbers, if you started with $10,000, you would currently be down $528, which is not great, but again, it did die in March, just like every single thing else other than tech stocks. And if you stuck your money in there the first day in 2018, then you would be currently down to about the same as what you started with, but it was down by 22%, of course, when the market just about had a aneurysm back in March. Now, I always look to see what the ETF holds. I want to know what they're holding, what they own, and of course, is it a good option for me? Now, what you're going to see here is some different companies that have a high dividend, which is going to help pay that 7% annual dividend, but also companies that have, when it comes to call options and stuff, if they've got good premiums. Of course, BMO ETFs, they always go way out in from the strike price, so that helps stabilize their prices and things like that for them. And some of the notable companies in my mind is HSBC. That's a very strong company, as well as Rio Tinto. That, in my opinion, is a very strong company as well. And when you do research for the other companies in between, of course, these are the highest weighted stocks in this ETF. They tend to be a very good. BP is another very strong one. PLC is very good. And I personally really like this ETF. Now, there's also basically a copy of this same ETF made by BMO. And what I mean by a copy is called ZWE, E as in extreme. Basically, it's a hedged ETF, and it basically holds that ZWP same ETF. It holds it, but it's hedged, which means that it's essentially not going to be changing with the currency. So if you're obviously buying in Canadian dollars, and you're now buying an ETF that's covering a European market, there's a different currency, and you want to hedge that so you don't have a stock that goes up 10%, but your currency goes down 10%, which makes it even and not worthwhile. Meanwhile, with the hedged version of the same ETF, then you're essentially going to be hedged against the currency fluctuations so that you're just getting the stock market returns. I hope that this video has helped you with understanding this ETF. If it has, hit that like button and subscribe, and I'll see you guys again next time.